Have you made a gift to someone and are curious how to correctly report it to the IRS? Stay with me and I'll tell you how. Hi, I'm Jared with Carlin Financial Group. For the best retirement information and to help make sure you don't outlive your money, be sure to subscribe to our channel and hit the bell so you'll be notified when we release new videos. If you're in the fortunate position of being able to provide a substantial gift to someone else, there's a few things you should know. Now, we covered many of the basics in our previous video about gifting and taxes, but today we want to take a look specifically at those of you whose gifts will need to be reported to the IRS and how to go about it. To report a gift to the IRS, you may have to file what's known as a gift and generation skipping transfer tax return, or IRS Form 709. In this video, we'll take another look at who needs or doesn't need to file this form and more about how it works. The first step is determining if you even need to file this form as part of your tax return. You'll be required to file if you meet one of the following conditions. Number one, you'll likely need to file this form if you gave gifts to someone other than your spouse, totaling more than the annual exclusion amount, which at the time of this filming is $15,000. But that number can change, so be sure to check for the current year's amount. Number two, if you give a future interest gift, which we discussed in our previous video, these types of gifts are not subject to the annual exclusion, but you must file a Form 709 even if it's less than the exclusion amount. Number three, if you split gifts with your spouse, as in you give each spouse credit for half of the gifted amount, regardless of the total amount, you must file. Any gift made from community property or from property held as joint tenants will also require you to file Form 709. Number four, it's important to note that spouses must each file their own form and cannot file a joint gift tax return. Number five, only individuals are required to file gift tax returns. If a trust, estate, partnership, etc. makes a gift, the individual beneficiaries, partners, or whatever the case may be, are considered the donors and may be liable for any applicable taxes. Number six, the donor is responsible for paying the gift tax. Now this one's important because if you're a donor and you fail to appropriately report your gift and pay any applicable tax, the person receiving the gift may have to pay the tax, which is typically not your intention. Finally, if a donor dies before filing a return, the executor must file. Again, if you don't give a gift to anyone but your spouse, none of your gifts exceed the annual exclusion amount, and they all represent present interest and not future interest gifts, you won't be required to file this return. One unique situation we sometimes get questions about is, what about gifts to charity? Well, typically, if the only gift you made that year were to charity, they'll be deductible from your taxes and you won't need to file a gift tax return as long as you transferred your entire interest in the property to qualifying charities. If you only transfer a portion or partial interest, or transferred part of your interest to someone other than charity, you must file and report all of your gifts to charity. As I said, these rules apply if your only gifts for the year were to charities. If, however, you're required to file a return due to non-charitable gifts and you make gifts to charities, you must include all charitable givings on the return. Remember that gifts don't just have to be cash. Let's say you give or transfer something of value for less than its fair market value. Perhaps you want to scale down and sell your house to a child, but you don't want them to have to pay full price, so you agree to sell it to them at $150,000 less than the fair market value. This excess $150,000 would be considered a gift and must be reported. This can also apply in situations of forgiving debt or making an interest-free or below market loan. There are other more unique situations like this, and for more information about those and how you could be affected, check out the link to the IRS page that I'll post down below. As we touched on in our other video, certain transfers are not subject to gift tax. Those can include transfers to political organizations, certain exempt organizations, payments made directly to a qualifying educational organization on behalf of someone else, or payments made directly to a person or institution that provides qualifying medical care for an individual. Now make sure you take note of the fact that for certain of these exclusions to apply, the payment must be made directly to the institution or caregiver and not to the individual that may benefit. Hopefully at this point you have a pretty good idea if you're required to file a gift tax return. I've covered the situations that will affect most people's giving, but there are some other more unique situations that may apply, and you can learn more about those by visiting the IRS link below. Once you've determined you need to file a gift tax return, it's important that you do so in a timely fashion. Generally, you must file no earlier than January 1st, but not later than April 15th of the year after the gift was made. If the donor were to pass away during the year the gift was made, the executor must file by the earliest of the due date of the donor's estate tax return, April 15th, or the extended due date granted for filing the donor's gift tax return. If you need more time to file, you can request an extension for your income taxes that would also apply to your gift return as well, or you can file a Form 8892 if you're specifically requesting more time just for Form 709 or your gift tax return. And please note that these extensions only apply to filing the gift return, not the time allowed to pay your taxes. Once you've submitted your return, should you discover you need to amend your Form 709, you'll need to file another 709 with amended entered across the top of page 1 of the form and pages 1 through 3 of the original Form 709 that was initially filed. If you fail to file or pay the resulting tax on time, it could result in a penalty unless there's a reasonable cause for the delay as determined by the IRS. If you've got more questions that I haven't addressed in this video, leave us a comment down below and we'll do our best to answer it in a future video. If you'd like our help determining how best to go about leaving on money, or if you've just received some money and want to make sure you're doing everything correctly, you can apply to work with us by clicking the link right down below in the description. Please make sure you share this with a friend who might find it beneficial. Give us a like and don't forget to subscribe to our channel and hit the bell so you don't miss any upcoming tips. And as always, live today, plan for tomorrow.